Good morning, everyone. Good morning, Manini. Good morning, whoever is joining. Okay, so today is our last session on business combination, and truly speaking, we have a lot to cover, lot to discuss. Uh, we'll be running through a couple of questions also, hopefully. So today's session, I will be extending a little bit, okay, because we'll have to complete the uh, chapter, and this chapter is going to have your what you say relationship with the next chapter that we are going to do that deals with consolidation. Okay, so I'll be extending a little bit. I'll be giving a break in between as well. Okay, so I hope that that keeps the things in perspective. So now coming back to what we had done in the last session. Last session we had ended with the discussion on existing stake is present in our what you can say is already present, and thereafter the control is obtained. So the obvious question would be, how would I do the PC calculation in that case? And we saw that you will have to perform a remeasurement of the existing stake, take the gain or loss on remeasurement to the profit and loss, and then you will eliminate that existing investment in the journal entry on account of acquisition. Okay, so this was what we had done. But obviously this remeasurement will depend on what is the accounting choice that you have adopted. Whether you have adopted the cost model, which is permitted for Ind AS 27 type of investments, like investments in subsidiary, associates, joint ventures. If it is none of these, then it will obviously appear at fair value, either FVTPL or FVTOCI, and accordingly, it would already be existing at fair value. So therefore, there won't be any change that is needed. However, the remeasurement gain or loss would appropriately be transferred to P&L or OCI as the case may be. If it is an FVT OCI scenario, then once the acquisition is done, you will have to transfer the fair value reserve to your what you can say retained earnings account. Okay, so that is how the accounting will happen. We had not taken a note on this, so we'll quickly write a note number 5. Okay, note 5, existing investments before control is acquired. Before control is acquired. Okay, so this is like, say you're having 10% or 20% stake and you are acquiring a further stake that gives you a control. So how are you going to record it? Okay, as per Ind AS 103, existing investments would also be regarded as a part of purchase consideration at their fair value. In case these investments are not at fair value, what will you do? You will remeasure. In case they are not at fair value, remeasure the same at fair value. The accounting for gain or loss on remeasurement would depend on the choice taken by the entity to account for the investments. Investments. Basically, these are equity instruments, so they would be nothing but financial assets. So in terms of Ind AS regime, we are having three options, broadly speaking. Okay, we are having three options. First one is you can hold it at cost, or what you call it as carrying value, which is choice for investment in associates or joint ventures or subsidiary as per Ind AS 27. So since this is appearing at cost, there would be a gain or loss on remeasurement, which will be transferred to P&L. Gain or loss on remeasurement transferred to P&L. Gain or loss on remeasurement transferred to P&L. If it is FVTPL model under Ind AS 109, obviously here also gain or loss on remeasurement transferred to P&L. If it is FVT OCI, what are you going to do? Gain or loss on remeasurement transferred to other comprehensive income. Transferred to other comprehensive income. Well, the moment I do the acquisition, when I have to record the net assets taken over, etc., you only told me in the last session that investment would be credited, which is correct in terms of the consolidation that is going to happen. The investments will be eliminated. So what am I going to do with that? Well, all these gains or losses are accumulated in other comprehensive income, and from there it would go to a fair value reserve that is sitting in your balance sheet. Now, since it is sitting in the fair value reserve, you are eliminating the investment when you are recording. I told you substance over form feels that you are disposing of the existing stake and acquiring a controlling stake. That is how the you can perceive the transaction to be. So since you are eliminating this investment, you cannot have a fair value reserve appearing in your balance sheet. So the fair value reserve will ultimately be transferred to your retained earnings in the consolidation that is going to happen. Okay. So balance in fair value reserve, other comprehensive income, to be transferred to retained earnings. To be transferred to retained earnings on the date of acquisition under Ind AS 103. Under Ind AS 103. Acha, why do I stress so much on fair value, fair value, fair value? Because ultimately I need goodwill to appear at fair value. So you are having on the debit side of the takeover entry net assets at fair value. You will be having your purchase consideration of the extra stake at fair value. So the investment that you are disposing of also has to be at fair value on the date of acquisition. We've already seen that. Okay. So when this is done, the goodwill, which is a balancing figure, will ultimately remain at fair value. That is why we do this fair value remeasurement. Okay. Is it fine? Have you guys noted this? Yes. Have you guys noted this part? Can I proceed further? Yes. Good morning, Srishti. Where are the others? Kaushiki, Shailendra, Soham. Okay. So Kaushiki has confirmed. Yes. Okay. All done. Noted. Okay, fine. So coming back to the place where we had left half a page for the purchase consideration, there you will have to write this additional item. Add. Wait 1 second. Here. This will be the purchase consideration, assuming no existing stake and 100% acquired in a single transaction. This would be the PC. But now you have acquired it in tranches. So add fair value of existing investments on acquisition. Note 6. So when this is the case, this will be purchase consideration after considering existing stake. So this is how your purchase consideration is going to be accounted for. A very, very important step in terms of your business combination. I told you it is a 6-step process. The first step is identifying who is the acquirer. The second step is determining the date of acquisition. The third step is by far the most important and the most lengthy step, that is determining the purchase consideration. In that, all the items are at fair value. Even the deferred consideration, we would identify what would be the value payable in the future, bring it to the present value. Okay, then contingent consideration we saw, and then pre-combination allocation in case of replacement awards. To that you will add fair value of existing investments, and that will give you the purchase consideration. That will give you the purchase consideration. Okay, so I hope you guys have noted this part, and now we are done with step number 3. The remaining steps are fairly small and simple. Okay, so they won't have a lot of adjustments, but yeah, there will be some small adjustments here and there, which we will now have a look at. Okay, now you have directly attributable expenses. Directly attributable expenses. See, an acquisition is not going to be a simple task. Okay, if you are going ahead with an acquisition, you will have to have a team of consultants in the form of advocates or lawyers who will draft the share purchase agreement or who will draft the acquisition terms. You will have a team of valuers who will do the fair valuation of the assets, who will do fair valuation of the liabilities. You will have a huge you will have a great number of bankers also in terms of how they will fund the acquisition. Are they going to give a loan? What will be the terms of the loan? So for each of these acquisitions that will happen, you will have a lot of expenses relating to ensuring that the acquisition gets done. So these are known as direct costs of acquisition. These are known as direct costs of acquisition. Where is this going to hit? Is it going to hit the profit and loss, or should it hit the goodwill? Should it hit the goodwill? So here Ind AS 103 tells, look, by hiring consultants, your acquisition does not become more valuable. Okay. So suppose you are doing an acquisition and you have a consultant in the form of your multinational accounting firms, then probably their charges will definitely be higher than if you hire a local accounting firm. So merely because a big four has done a consultancy, it does not make your acquisition more valuable than it actually should be. More valuable, when I use the term, it means goodwill. It means goodwill. You cannot debit the consultancy fees that are charged by the consultants to goodwill, because consultation does not result in increasing the value of an acquisition. It is merely facilitating the acquisition process. It is ensuring that the acquisition goes through. So these expenses will definitely go to the profit and loss account. They cannot be taken to goodwill. So it will be a huge impact. Yes, it's going to be, but fact is acquisitions don't become valuable on account of consultancy fees. Okay, so that is the first thing. The next part is, if it is a business combination in the nature of amalgamation, absorption, etc., then your existing company is going to shut down, and ultimately you will be transferring the assets and the liabilities physically. So when you transfer the assets, you are going to incur certain statutory fees. Like, for example, stamp duty will be paid if you are transferring immovable property. If you are transferring movable property, some kind of tax is going to be paid to the government. Some kind of charges will be done. Some processing fees will be done. So all these items are for changing the name, changing the ownership from the selling company to the purchasing company. Ideally, if it were to be an asset acquisition, these costs would have been capitalized. These costs would have been capitalized, but here it is not an asset acquisition, it is a business combination. You are acquiring a business, you are not acquiring assets. So therefore, we want to stress on the fact that all the assets which are being brought into the books after the acquisition, they have to remain at fair value only at fair value. So therefore, I cannot taint this. I cannot put a mark on this fair value by adding transaction costs to it, So in this case alone, in business combination, even the transaction costs, that is costs necessary to bring the asset to its existing location and condition, in this case also it will not be capitalized. It will be taken to the profit and loss account. You cannot take the net assets at fair value plus the transaction cost. That is not permitted in Ind AS 103. Ind AS 16, transaction cost should be capitalized. Ind AS 38, capitalized. Ind AS 40, capitalized. But Ind AS 103, you cannot. You have to take it at fair value, because ultimately the objective is to ensure my goodwill appears at fair value, which is possible only when all the remaining items are appearing at fair value. Okay. So you can note this small note down. As per Ind AS 103, all expenses linked to acquisition should be transferred to P&L and not goodwill or capital reserve. Not goodwill or capital reserve. The question will try to confuse you, and it will almost make you say that put it in goodwill or capital reserve. They will say this is a one-time expense. It is a huge cost. It is going to hit my P&L. The management feels that since this is related to acquisition, it must be taken to goodwill. The question will almost always try to force you to give the wrong answer, but keep your principles in mind. Okay. So directly attributable expenses can be of two types. First one is direct cost of acquisition. Example, consultants, bankers, liquidators expenses. If the selling company is going to shut down, where will this go? Without doubt, this will go to the profit and loss account. The other case would be expenses linked to transfer of assets in the name of the acquirer. Example, stamp duty, brokerage, registration fees, etc. Where are you going to take this? This also will be taken to the P&L account. This also will be taken to the P&L account. Have you noted this part? Have you noted this? Yes. Yes. Okay. All right. So all of you have noted this. So this goes to profit and loss account, and that is done. Okay. The reasoning is assets or liabilities have to appear at fair value. As per Ind AS 103, net assets should appear at fair value only and not fair value plus transaction costs. नहीं होगा. Okay. Hence, expenses related to acquisition of net assets should be expensed in P&L. Though the same may be capitalized under other standards like Ind AS 16, 38, 40, etc. Okay. So this is the reasoning that is there. This is the reasoning that is there for you. Okay. All right. Step up. Okay. Fair enough. Done. Did you note this part down? Yes. Good morning, Jagatish. Yes. Okay. All right. So now coming back to this was step number 3, and then the small note on directly attributable expenses. Step 4 is net assets taken over. Net assets taken over. Okay. Very simple for the time being. We will add certain additional adjustments later on, but as of now, important thing is this will always appear at fair value on the date of acquisition. The second point to notice, regardless of the stake acquired, you may have acquired 50%, 60%, 80%, 90%, 100%. Regardless of the stake that you acquire, the entire net assets at 100% value should be recorded. Okay, entire stake should be recorded. So we'll just write this small point. There will be a couple of adjustments, 2 to 3, like maybe deferred tax could be one, leases could be one, contingent liabilities could be one, indemnification assets. So these 4-5 adjustments are there. We will take that at a later stage because we'll first complete the understanding till step number 6, that is goodwill, and then we will come back to net assets taken over. Okay. So assets, liabilities should be recorded at fair value on date of acquisition. Further, 100% of the assets or liabilities should be taken over. Regardless of percentage of stake acquired. Okay, so this is what you will have to remember. Okay, couple of adjustments in net assets, we'll see that later. It's not a major thing. Okay, so coming back to our step accounting, step 5, non-controlling interests, NCI. Soham is not there around today. I'll come to that. When I'm doing step number 5, I will explain to you. Okay. It's Kaushiki. Okay. Have you guys noted down? Yes. That's right, Srishti. Okay. Okay, fine. So you will understand why it is 100% always. We will understand it when we are now going to look at step number 5. Okay. So now, see, on the very first day of the session, now don't write down, just listen. On the very first day of the class, I had told you that business combination could be either in the form of amalgamation or absorption, or it could be in the form of acquisition of controlling stake in another company. Okay. Now, when this is your case, what happens is selling company, I'll call it S Limited, this will shut down, and all, I repeat, all assets and liabilities transferred to the purchasing company P Limited. This is what you have done in AS 14. Although some things are different, but this is exactly what you used to do in AS14. So all means what? 100% of the assets and liabilities are transferred to P Limited. So this is what exactly you used to do in AS14, although some things are different. So I'll just remove this off. This is not to ensure that you'd start drawing exact parallels. There are some differences. Okay. In the case of acquisition of a controlling stake, in the case of acquisition, is S Limited shutting down? No, S Limited exists. S Limited exists. So what I am going to have is in P Limited's balance sheet, I will be having investment in S Limited. Investment in S Limited. In S Limited's balance sheet, I will be having equity share capital, assets, liabilities, reserves and surplus. Okay, I'm just drawing a rough balance sheet. Don't say that this is not as per Ind AS, etc., etc. Okay, so this is how your structure appears even after the controlling stake is acquired. But from the perspective of the owners of P Limited, tell me, is this going to make sense that investment in S Limited appears? Suppose you are owning shares of Reliance. You are owning shares of Reliance. Will it make sense to you for your own analysis to look at Reliance Industries standalone? Reliance Industries standalone mein what all is going to come? Investment in Jio platforms, investment in Reliance Digital, investment in Reliance Trade, investment in Reliance Trends, investment in Reliance, whatever it is. Okay. So all these items will come as investments. Is it going to make sense to you in that perspective, or will it be better if these investments are replaced by P Limited consolidated? Is it going to make sense if these investments vanish? In its place, you will have net assets of P and S both. Obviously, this is going to make more sense because your investment in Reliance is a representative of all the net assets of Reliance. Similarly, the investment of Reliance in the subsidiaries is a representative of the net assets of the subsidiaries. And therefore, it is going to make infinitely more sense to us when we remove the investment in S Limited and replace it with the net assets of S Limited in the financial statements. Similarly, today, if I look at Reliance's business, there is a substantial chunk of income that is coming from Reliance Jio platforms. Okay, Jio platforms is today having a huge number of subscribers. There is a huge amount of income, huge profit generated by Reliance Jio, and therefore, it makes sense in the P&L of P Limited to include the profit that Jio is making, So therefore, if I have to include the profit, I will have to eliminate the investment that Reliance has made in Jio platforms. Eliminate means what? In the consolidated financial statements, we will not see investment in Jio platforms. We will not see that. In this case, we will not see investment in S Limited. Instead, we will see P Limited net assets. To that, you are going on adding S Limited's net assets. To that, you are going on adding S Limited's net assets. You will add liabilities. All of it will be added. So in the end, what is going to be presented to you, the reader of financial statements, is a consolidated balance sheet of P Limited. A consolidated balance sheet of P Limited in which all the assets of the group are going to appear. All the liabilities of the group is going to appear. The entire reserves and surplus of the group is going to appear, and the equity share capital of the parent is going to appear. So this is a better financial reporting from that perspective. Okay. Now coming to the next part, sir, is it possible that you can get control? Or the first question is, sir, to get control, is it necessary to acquire 100% stake in the subsidiary? Answer is no. You can acquire a controlling stake. Please remember 103 does not, 110 on consolidation defines the term control, and control nowhere has the meaning that a particular percentage of stake is ascribed to it. Okay, zaruri nahi hai. So for example, we saw that companies like where there is a stakeholding of 40-45%, etc., all of them also will have to start consolidating, because the remaining shareholding is distributed among a huge number of individuals who are spread across the length and breadth of India. So therefore, they cannot really influence the decisions which are being taken, and though you have a less than 50% stake, you will still end up consolidating. So now, when I hold less than 100% stake, for example, we again come to Reliance. Reliance started out with incorporating Jio Platforms as a wholly owned subsidiary, wholly owned subsidiary. Later on, if you guys remember, somewhere when COVID was at its peak, okay, the first lockdown, at that point of time, what was happening was Reliance started to slowly sell the stake in Jio Platforms to entities based in Saudi Arabia. They transferred some percentage. I think Facebook or Google also acquired some percentage. So it divested about 15 to 25% of its stake in Jio Platforms. So when Reliance divested about 15 to 20%, let us take 20% for ease. Now Reliance owns 80% of the share capital of Jio. 20% is held by outsiders. Now you tell me, by virtue of this holding, do you think that Reliance Industries can control only 80% of net assets of Jio, or can it exercise 100% control over the net assets of Jio? Where to put the tower, where to how much to invest in the 5G spectrum, if all these decisions are to be decided by Reliance, can it decide only to the extent of 80%, or can it control the entire asset? Suppose Jio has a land at a particular site and Reliance wants to sell that land. You tell me, will Reliance be able to sell only 80% of that land, or will Reliance be able to sell 100% of that land? But whatever gain is going to come, 20% will be attributed to those non-controlling interest. What do you think Reliance will be able to do? Will it exercise control only on 80% of the net assets, or will it exercise 100% control with a 20% share of the non-controlling interest that will be allotted to them? Obviously, Reliance will be able to exercise 100% control. Any subsidy, any parent for that matter, any parent, okay? You have 60%, yes, it means you have a control of the entire net assets. आपको जो कुछ भी करना है उस कंपनी के साथ आप कर सकते हो. You can do whatever you want with the net assets, because what you will do, you will call a board meeting, you will say take these decisions, and since you are having the control, therefore you will go and sit and decide on the net assets of the subsidiary. 100% control. So everybody is saying, Kaushiki, Aniket Jain, Srishti, everybody is saying they will be exercising control over 100% of the net assets. And that is why That is why in step number 4, all the assets should be taken over, entire 100%, regardless of what is the stake that you are acquiring, regardless of what is the stake that you are acquiring. So that is why step number 4, we have mentioned that. Coming back to step number 5, the question is, where will I record the balance 20%? Where will I record the balance 20%? It could be anything, I repeat, 20, 30, 40, 50, 60% also. Okay. Here the word used is not minority interest. In AS21, you had the concept of minority interest because AS21 focused on stake. AS21 said if you hold more than 50%, you will have to take it as a subsidiary. If your holding is below 50%, it will not be your subsidiary. But Ind AS tells us, don't look at stake. Look at whether you have control or not. You may have a control with only a 40% stake because your remaining 60% is widely distributed. So in every general meeting that happens, सिर्फ आपका राज है. You are alone able to determine what is going to happen because इतने सारे लोग तो general meeting में आएंगे ही नहीं. So therefore, in substance, you are controlling, although it is a less than 50% stake. So therefore, the NCI will be a 60% stake. The NCI will be a 60% stake. So we cannot call them minority interest because they are holding a greater number of shares. But since they don't have control, we will be calling them as a non-controlling stake. Okay. So now let us move on to understand more and more about non-controlling interest. And this is where things are going to get slightly, I won't say difficult, but slightly different compared to what you have studied. Okay. Okay. So now let us take this particular case. Okay. 1/4/2021. P acquires 80% stake in S. P acquires 80% stake in S. Book value of net assets of S is equal to $250,000. PC is equal to one second. $425,000. PC is equal to 425,000 for 80% stake. No existing investment. Okay, so it is acquired at one time only. No existing investment, and this is paid in cash, so it's fairly simple. Okay. Fair value of net assets on 1/4/21. This is subsidiaries net assets. Okay, so this is 350,000. Okay. So now the question is this a business combination? Obviously it is. P has acquired 80% stake. In absence of information, we take that control is transferred. So control is there. So all these things are there. So we follow the 6-step model. The 6-step model tells us that step number 1, identify the acquirer. Sir, in this case, acquirer is P. Date of acquisition, which is 1/4/21. The third step is purchase consideration. Purchase consideration is 425,000. Step number 4, net assets taken over. This is going to be 100%, 3,50,000. This is going to be 3,50,000. And now, if I have to pass the takeover entry in the consolidated books, can I pass an entry like this? Net assets account debit 3,50,000 to bank. This is the PC, 4,25,000. So the difference of 75,000 goes to Goodwill. Is this entry correct? Is this entry correct or is this wrong? Is this wrong? Is this entry correct or is this entry wrong? Come on, now you tell me. You cannot pass this entry. You cannot pass this entry. Why? You are recording net assets at 100%. Your purchase consideration represents only 80%. Where is the remaining 20? Where is the remaining 20? If I have to do a balancing figure, it should be 100% on the debit side and 100% on the credit side. It should be 100% on the debit, 100% on the credit, which is not the case. So therefore, we will have to record something known as non-controlling interest. We will have to record something known as non-controlling interest. So step number 5 is going to be my NCI. NCI will be recorded at which value? NCI will be recorded at which value? And here Ind AS 103 gives you two options. Ind AS 103 gives you two options. First option, many of you would already have calculated and you would have calculated correctly. NCI represent a stake in the subsidiary. Subsidiary's net assets is 3,50,000. So NCI stake is 20%. So this comes to 70,000. This comes to 70,000. So therefore NCI will be 70,000. NCI will be 70,000. And accordingly, what is going to be your goodwill? What is going to be your goodwill? 425 plus 70, 495 minus 350, 1,45,000. 1,45,000. Is this clear to everyone? Is this clear to everyone? Yes. Srishti, did you understand? Sumit Jain, Aniket Jain, Manini, did you understand? Many of you would have already determined this. It is correct. It's not wrong. This is one of the ways in which NCI can be calculated. This is one of the ways in which NCI can be calculated. Have you guys understood this part? Yes, sure. Okay. Now, let us look at further. We'll split this. Okay. See, net assets of subsidiary is 3,50,000. Okay, at fair value. See, technically, I will control 100%. I will be controlling 100%. But legally speaking, hypothetically assume that S Limited goes into liquidation. If S Limited goes into liquidation, my share, P Limited share kitna hoega? P Limited share is going to be 80%. P Limited share is going to be 80%. And if it is going to be 80%, what is going to be my share? 2,80,000. My share is going to be 2,80,000. Sir, what about the remaining 20%? That will go to that other person, na, jiska naam NCI hai. So 70,000 will go to NCI. This is P, this is NCI. Now just pay attention. To acquire this 2,80,000, I have paid how much? 4,25,000. So now if you do a subtraction, 4,25,000 I paid to get a stake of 2,80,000. I have done an overpayment of 1,45,000, which is nothing but goodwill, So in other words, have you understood this part? See, I want you to be very clear now. Have you understood this 1,45,000 first way of calculating? Have you understood 1,45,000 second way of calculating? Is it clear to all of you, both these things? And I also want you to tell me that you are convinced that both the ways of calculations are correct. Both the ways of calculations are correct. Okay. Are you clear? Yes. Absolutely. Fine. So now look at the words which I'm now using. Can I now say that 1,45,000 of goodwill is attributable only to the parent? Nothing is attributable to NCI. Sir, क्या बोला? फिर से बोलो. ये जो 1,45,000 goodwill है, it is attributable only to the parent. Nothing in this goodwill belongs to the NCI, because I have shown you that this 1,45,000 is purely arising on account of the payment made by the parent to acquire a controlling stake in the subsidiary. That means this excess payment is solely attributable, can solely be identified to belong to P Limited. Nothing in this goodwill belongs to non-controlling interest. Are you okay now? Have you understood? Yes. This goodwill of 1,45,000 is solely attributable to the parent. Okay. All right. Everybody understood this? Yes. Everybody understood? Okay. So in the first step, in the first scenario, NCI is calculated at proportionate share of net assets of S. NCI is calculated at the proportionate share of net assets of S. If this is done, then you will get some goodwill. That goodwill is attributed solely to the parent. This goodwill is attributed solely to the parent. That is, nothing will be attributable to NCI. And this is always going to be true. Okay. When you are calculating your NCI as a proportion of net assets of S, the goodwill that arises will be attributable entirely to the parent, and nothing will be attributable to the NCI. All right. Now, let us look at the second case. Let us look at second scenario. The second scenario, Ind AS 103 gives another option of calculating the NCI. Okay. Let us assume that when I say 80% stake, it means 80 shares. So NCI stake is 20 shares. Okay, I'm keeping it simple so that you can understand. Okay. See, Ind AS 103 understands that these are shares. Let us assume that these shares are traded in the market. Let us assume that these shares are traded in the market. That means NCI's shares are 20 in number. Let us assume the market value is rupees 5,000. Let us assume the market value of these shares is 5,000. So alternatively, can I say that NCI on the date of acquisition is rupees 1 lakh? Yes or no? Array, if I have to buy these 20 shares, I will have to pay the NCI 1 lakh rupees. I will have to pay the NCI 1 lakh rupees because that is the market price of the shares. That is the market price of the shares. Have you understood this? So this is the second alternative. This is the second alternative wherein I can measure NCI at the market value of the shares. I can measure NCI at the market value of the shares, which is 1 lakh rupees in our example, which is 1 lakh in our example. Sir, market value has another word in terms of Ind AS 113. It is nothing but fair value. It is, what is fair value definition? It is the price to sell an asset or transfer a liability in a transaction between market participants at the date of measurement. So market value in this case would be an observable input, a most reliable input, and therefore this would be nothing but the fair value. That means in the second method, the NCI which is being calculated is NCI at fair value. The first case, the net assets of S are fair valued and NCI was being recorded at a proportionate share in the net assets of S. In the second case, NCI is being calculated at fair value, which is market price of S multiplied by the shares held by NCI, not P. NCI do not hold shares in P. NCI is holding shares in S. So NCI's number of shares held multiplied by share price of S is going to give you the fair value of NCI. And now let us look at the entry that is going to change. NCI here will now no longer appear at 70,000. It will appear at 1 lakh. It will appear at 1 lakh. And the goodwill will not appear at 1 lakh 45. It will appear at 1 lakh 75,000. It will appear at 1 lakh 75,000. But if you look at the goodwill calculation, we had understood that 1 lakh 45,000 is the goodwill attributable to the parent. But your total goodwill is 1 lakh 75. So out of 1 lakh 75, 1 lakh 45 is attributable to the parent. That means the balance 30,000 in this case will be attributable to the NCI. The balance 30,000 will be attributable to the NCI. Have you guys understood? Yes. Have you guys understood? Is it clear now? Yes. Yes. All clear. Now I want you to tell me, from your perspective, which calculation makes more sense? The first calculation where NCI is at proportionate share of net assets, or the second calculation where NCI is calculated at fair value on the date of acquisition? Which transaction makes more sense to you? Let me tell, both are permitted. Ind AS 103 permits the first also, permits the second also. So I'm not saying that to choose what is going by Ind AS 103 or not. I'm only telling which transaction appears to be more logical. Give your answers. I'm getting somebody saying second, somebody saying first. Okay. So come on, tell me which answer appears more logical. Second. Many of you are saying second, which is actually right. See, what is the first case? The first case is NCI at proportionate share of net assets. Now, if this was the case, goodwill that arises is going to be attributable only to the parent, Suppose the parent wants to acquire a further stake in the non-controlling interest. Suppose the parent wants to acquire further shares, मतलब parent के पास 80% है, he is not satisfied. उसके मन में there is this deep desire to acquire that remaining 20% also. तो वो क्या करेगा? वो जाएगा NCI के पास, वो बोलेगा I want to buy your shares. Do you think NCI will sell the shares at 70,000 rupees? Do you think P is in a position to argue that, Dick, the net assets is 3,50,000. 3,50,000 ka 20% is 70,000. I am going to give you only 70,000. Can P Limited argue like that? Or will NCI say, वो जो मार्केट दैट इज वॉट एवर इज दैट वैल्यू, उसका मेरे से कोई संबंध नहीं है. मार्केट वैल्यू इज 1 lakh rupees. You pay me 1 lakh rupees and take the shares. What do you think will happen? Do you think NCI will ultimately be able to sell at 70,000, or do you think NCI will be able to sell at 1 lakh? Obviously, it is going to be sold at 1 lakh. Obviously, it is going to be saleable at 1 lakh rupees. And that is why the second method starts to make more sense. Because that represents how much NCI can have a claim. Okay, so that is the reason second method is more preferable. NCI will demand, मेरा शेयर चाहिए ना भाई, जितना मार्केट प्राइस है वो दे दो मेरे को. You give me the market price and I will willingly transfer my shares to you. That is why 1 lakh makes more sense, where the goodwill is attributable to NCI to the extent of 30,000. So now coming back to the discussion on goodwill, by sum total में क्या है? When I record the NCI at proportionate share of net assets, the goodwill is attributable only to the parent. इसको हम लोग बोलते हैं partial goodwill. We call this as partial goodwill. Goodwill attributed only to the parent. Goodwill attributable only to the parent. इसको हम लोग क्या बोलते हैं? We call it as partial goodwill. In the second case, when NCI is at fair value, the goodwill will be attributable to both the parent as well as the NCI. तो इसको हम लोग क्या बोलेंगे? Partial का opposite is full. So if you record NCI at its fair value, the goodwill that will be recorded is known as full goodwill. The goodwill that is recorded is full goodwill. Both are permitted in Ind AS 103. Both are permitted in Ind AS 103. Is this clear? Have you guys understood partial goodwill, full goodwill, NCI at fair value, NCI at proportionate share of net assets? Have you guys understood this part? Yes. Kaushiki has confirmed. Okay. Sir, goodwill. No, Srishti, goodwill is not arising by the reputation. Bhul jao. That is a concept which is fed in your mindset. I don't blame you, but that is what you have been taught. That is what is ingrained inside you. That is what is a part of your system, because you've always been taught what is goodwill. How did we understand goodwill? See, this is a problem with the accounting that is taught at the initial levels. Okay, in your schools, colleges, wherever you had accounting, the first thing that you think, intangible asset kya hoga? Goodwill hoga. What is goodwill? It is the monetary amount given to the reputation of the company. आपका सोच यही होता है. And when you do your partnership accounts, you are given to calculate the goodwill. You are given to calculate the goodwill, and this goodwill is going to be calculated by that super profit method, average profit method, annuity method, capital है, पता नहीं क्या क्या method है वो. But that is not goodwill. First part. That is an estimate. Second part, it is the reputation that you get is an internally generated asset. Strictly internally generated intangibles can never be recognized as an asset, either under AS 26 or under Ind AS 38. So the goodwill that arises by work of a company is a very, very incorrect concept in terms of accounting. आप मुझे बताइए, you tell me one thing. You have a relationship with a supplier. You have a relationship with a supplier. You are very prompt in your payment. वो 30-day credit देता है, 29th day आपका payment पहुंच जाता है. हमेशा, always. 30-day credit, 29th day. 35 days credit, 34th day. You have very beautifully managed to maintain the relationship with this supplier. By virtue of this very good relationship, your supplier is going to give you preferred pricing as compared to the others. Your supplier is going to give you preferred pricing as compared to the others. So, in a sense, your prompt payments and good relationship has given rise to a better pricing. Has given rise to a better pricing. इसको हम लोग goodwill बोल सकते हैं, but ये बोलचाल की बात है. This is a normal layman's language. When you make a prompt payment, can you, as an accountant, identify this prompt payment में से goodwill के लिए कितना है, material के लिए कितना है? Can you identify that? You cannot. You are making payment only for acquiring that raw material from your supplier. The fact that you are making a prompt payment is giving you better prices. The better prices will also be recorded as material cost in the future. तो भाई goodwill कहाँ आ रहा है? Goodwill can come only if you can attribute it directly. यहाँ पे तो कोई attribution है ही नहीं. There is no attribution here, and therefore I cannot record goodwill on account of work, on account of reputation. अगर ऐसा बात होता, if this was the case, today we all know what reputation Tata Group carries. What reputation Tata Group carries. So उनके balance sheet में तो goodwill जो रहेगा, that should be greater than all the tangible assets that Tata Group owns. Because Tatas are known for its ethics, Tatas are known for its value systems, Tatas are known for basically everything that is true, fair, and in the interest of the society. But do you think Tata's balance sheet has goodwill on account of the work that it has done? It doesn't. Only one type of goodwill is permitted in your accounting, and that is purchased goodwill or acquired goodwill. That's it. And purchased goodwill or acquired goodwill is nothing but the surplus that you have paid, the extra that you have paid over the net assets of the target company. The extra amount that you have paid over the net assets, that alone becomes your goodwill. उसके अलावा आपके बैलेंस शीट में कोई भी गुडविल नहीं होगा, कोई भी गुडविल नहीं होगा, नहीं होना चाहिए. It should not be there. That is why when you used to do partnership accounts, I don't know, but normally when we used to study partnership accounts, goodwill was raised and immediately written off. Goodwill was raised in the old profit sharing ratio, immediately written off in the new profit sharing ratio. And every time we used to argue, यार raise भी करना है, write off भी करना है, तो raise क्यों करना है? Raise क्यों करना है? That was the question we always used to ask. It used to be raised and written off because I cannot show that goodwill in the balance sheet. I cannot show that goodwill in the balance sheet. Okay, because that would be an internally generated goodwill which can never be measured reliably. To record an asset to record an asset, the fundamental requirement is reliably measurable. It should be measured reliably. Internally generated goodwill can never be measured reliably, and therefore प्लीज उस बात को भूल जाइए. आई एम वेरी हैप्पी somebody brought this up, because otherwise वो हमारे it is there in our psyche that goodwill is the monetary value of the reputation of an entity. वो सब नहीं है. It's all stupid understanding. Okay, I can say it at this level because you will be able to appreciate it at this level. Okay, I cannot say this to somebody who is studying partnership or somebody who is studying in class 11 or 12. Okay, but now at this stage I can tell you, because you are fairly advanced to appreciate the finer aspects of financial reporting. Okay, so goodwill is purely going to be acquired goodwill, purely going to be purchased goodwill, and this method of NCI at fair value, NCI at proportionate share of net assets, both will give rise to two different figures of goodwill. In one case, the goodwill will be solely attributable to the parent. We call it as partial goodwill. In the other case, when NCI is at fair value, we will get goodwill attributable to the NCI as well, and we call that as full goodwill. We call that as full goodwill or complete goodwill. Okay, so that takes care of NCI at fair value, NCI at proportionate share of net assets, NCI at proportionate share of net assets. Okay. सर एग्जाम में क्या करना है? बहुत ज्ञान बांट दिया. ओके, यू हैव गिवन अस लॉट ऑफ नॉलेज. आप मूट क्वेश्चन पे पॉइंट पे आकर कहिए एग्जामिनेशन में क्या करना है. ओके सर, इन एग्जाम यू विल फॉलो NCI at fair value only if market price of shares of S Limited is given. Only if market price, देखो NCI at fair value के लिए you need to know the fair value of the equity share of S Limited, and fair value of equity share means the market price of shares of S Limited. So number of shares held by NCI into the market value gives you the NCI at fair value. So when you are given the valuation, the market price of shares of S, that is an hint that you have to measure NCI at fair value. That is a hint that you will have to measure NCI at fair value. Sir, in balance sheet, you just show the goodwill. Partial goodwill, full goodwill कहने की कोई जरूरत नहीं है. You do not have to mention anything. In the policy, accounting policies that you mention, see, your financial statements will contain accounting policies. In your accounting policies, in the consolidated financial statements, you will have to explain the basis for consolidation. In the basis for consolidation, you will explain that NCI is measured at fair value, and that is why goodwill will be a full goodwill. Otherwise, you will say that NCI is measured at partial and is measured as proportionate share of net assets, and therefore the goodwill will be partial. It will be shown as a disclosure, but not on the face of the balance sheet as full or partial. It will be shown only as goodwill on the face of the balance sheet. Okay. All right, so that takes care of this part, what to do in the examination, what to do in the examination. Now let us move on to the next part. Let us move on to the next part. Okay. Sir, sometimes it may so happen, just 1 second. All right. Okay, so that is Manini's question. Okay, so now we move on to another scenario. See, sir, purchase consideration is 4,25,000. This is at fair value. You have always been shouting, fair value, fair value, fair value. So this is for 80% stake. This is for 80% stake. Sir, agar because there are some extra brilliant students. I don't blame them. Okay. There are some extra brilliant students. who will say NCI at fair value निकालना है भाई, अपने को correct reporting चाहिए. So market value is not given, but there are some thought processes which run like this. Sir, PC is at fair value, so that is 80%. तो हम लोग 20% क्रॉस मल्टीप्लाई कर सकते हैं ना. वी कैन डू अ क्रॉस मल्टीप्लीकेशन. 4,25,000 into 20 divided by 80. 425 into 20 by 80. So this comes to 1,06,500. सर हम लोग ऐसे भी तो पकड़ सकते हैं ना. We can take it like this also. ऐसा कभी मत करो. Don't do this ever in your life. Okay. Please don't do this. Sir, why not to do this? See, this is a controlling stake. This is a controlling stake. Sir, what do you mean by controlling stake? Controlling stake means it is giving you the ability to take decisions of S Limited also. That means Reliance Industries Limited. Suppose it has a market cap of 1 lakh. Okay, I'm keeping it very simple. Okay, Reliance Industries has a market cap of 1 lakh. 50% means 50,000. So more than 50% means, suppose you want to acquire 51%. You will go to Mukesh Ambani's house and tell Mukesh bhai, I'll pay you 51,000. Give me 51% of shares. Give me 51% of the shares. Okay. Do you think Mukesh Ambani will agree to receive 51,000, or do you think Mr. Ambani will ask for something more than 51,000? क्या लगता है आपको? What do you think? What do you think will be the case? Do you think Mr. Ambani will give you 51% shares for 51,000, or he will ask for more? He will definitely ask for more, because in this case, what is being transferred is not only shares, but Mukesh Ambani is transferring the control that he has along with the shares. Shares is equal to voting rights. So when you are going to ask for 51% shares, आपका दिमाग सीधा नहीं है. आप 51% नहीं मांगोगे. What you are going to say, it will be more than 51,000, means you are asking for control. तो मुकेश अंबानी will say, देख बेटा 51% तो ले ले, but I will not settle for 51,000. सर मार्केट प्राइस 50, मार्केट प्राइस से कोई संबंध नहीं है. मार्केट प्राइस में आपको शेयर मिलेगा 51,000 के लिए, but today when you have come to me, you will be getting control from me along with the share. So I will not settle for 51,000. I will be settling for something like say 60,000. दे सकते हो. If you are really serious about acquiring, pay 60,000 and get the 51% share. So this 4,25,000 is not as simple as saying number of shares of P multiplied by market price. It is not this value. It is not this value. It is something far more than this value. एक और दृष्टांत देने के लिए, to give another very relevant comparison. Okay, to give another very relevant comparison, आपके एग्जाम में आप 59 पे आके पहुंचते हो in your total, and आप 60 के बहुत नजदीक हो. Do you think the hard work required for getting from 59 to 60 is the same as moving from 58 to 59? The hard work, the effort, the presentation, the accuracy, the perfection that is required to get a score from 59 to 60, is it the same as the effort required to get 58 to 59? Answer is no. ये सबको पता है. Okay, 59 to 60 का jump चाहिए. Your exam paper should have something very special about it. After that, 60 to 61, 62, 63, that is very simple to score. But getting this jump is something that is huge. Similarly, getting a controlling stake is a very huge thing in the case of a business, is a very simple case, is a very similar case for a business. And that is why, please, please, please do not make the mistake of cross multiplying. In our example, you saw that NCI was appearing at 1 lakh at fair value. If you do a cross multiplication, it is coming at 1,06,500. Kahan se fair hoga? This is not going to be fair because in this case, in a crude fashion, 6,500 extra is there. Why it is there? Because that represents a control premium. When you are evidencing interest in acquiring NCI, control premium आपके पास है, control as है ही है. You already have the control. The NCI is not giving you anything extra. The NCI is not giving you anything extra. आप already control है आपके पास. You are already controlling 100% of the net assets of S Limited. By acquiring this 20%, the only thing that you can get extra is what? Only the dividends which you were earlier getting 80%, you will now get 100%. That's it. You are not going to get even 1 penny extra benefit from acquiring the balance 20% stake. And that is why it is absolutely incorrect to record at 1,06,500. I will do the accounting at 1 lakh only. So don't make the mistake of cross multiplying this fair value to the non-controlling interest stake and say that NCI at fair value can be calculated in this manner. No, it cannot. NCI at fair value means only NCI shares multiplied by market price. That's it. End of discussion. Okay. And goodwill. Okay. So now ये तो हो गया academic चीजें. Okay. Now coming to practical life. Sir, what do you think companies will follow? Do you think companies will follow NCI at fair value, or do you think companies may prefer proportionate share of net assets? Depends. But ideally, if management is of the opinion that it wants to acquire the NCI at some point of time, it is clear, then I would say the presentation would be more fair to measure NCI at fair value. Okay. If there is no intention, भाई हम खुश हैं, NCI भी साथ में ठीक है, वो रहेगा. Anyways, all the decisions I am only taking. So NCI is going to get some dividend. So let it take. I am not bothered. Okay. So if that is the case, you can record NCI at proportionate share of net assets. Okay. So it all depends on how are you going to record. What is your intent with the NCI? Practically, a full goodwill approach is there because ultimately going for a full goodwill approach is going for a NCI at fair value shows your interest that you want to acquire it in the future. Okay. Nothing wrong in that. Sir, हमने NCI at fair value किया, but then we never acquired the NCI. तो भी ठीक है. It's perfectly fine. Your decisions can change over a period of time. Okay. You will not restate the NCI at that point of time. Not needed. See, NCI at fair value, NCI at proportionate share of net assets, this decision is going to be taken only once in the lifetime of the company. And that is on the date of acquisition. हमेशा याद रखना, 103 is applicable only on one day, and that one day is the date of acquisition. After that, 110 replaces Ind AS 103 at every reporting date. After this, NCI may only two things will change. First one is share of profits will go on getting added. If any dividends are paid, that will be reduced accordingly. Uske alawa kuch bhi nahi hoga. Nothing else is going to happen to NCI practically. So this one decision is going to be taken only once in a lifetime. That is on the date of acquisition of the end of the company. Okay. So ye ho gaya NCI. Now last part is where am I going to present this NCI? Sir, will I present this NCI in the standalone financials or will I present this in the consolidated financials? Standalone mein. Again, I repeat, look at this. In standalone of P, there is only one item which appears, that is investment in S Limited. When I move to present consolidated financials, the investment in S will vanish. Ye chala jayega. It will be represented by net assets of P. Now, suppose I am having 80% stake of investment in S. This 80% stake of investment in S is going to be replaced by 100% of the net assets of S. So obviously, where will I show the 20%? This 20% NCI will be shown in the consolidated financials, will be shown in the consolidated. Standalone may nothing will happen relating to consolidation. Standalone, nothing will happen relating to business combination in the nature of acquiring a controlling stake. Standalone ke case mein, you will have the effects of amalgamation absorption in this case, this scenario. Acha, if it is in the nature of amalgamation absorption, there won't be NCI here. No non-controlling interest. Sir, non-controlling interest, for that to be there, S Limited should exist in the first place. But here what is happening? S Limited bachta kidhar hai? S Limited is shutting down. So therefore, there is no S Limited. There cannot be an NCI here. So in this case, you will replace the 80% investment with 100% net assets and 20% NCI only in the consolidated financials. This takeover entry, where are you going to pass? This will be in the consolidated financials only. All right. So Kaushiki, hope that query is addressed. Okay. All right. Now coming back, sir, consolidated may be, where am I going to show it? Will I show it as equity? Will I show it as liability? Will I show it as current liability, non-current liability? Where do I show? Understand who are NCI? Who are NCI? And then give me the answer. Where will it come in the consolidated financials? Will it be shown as equity? Will it be shown as a liability? Will it be shown as a current liability, non-current liability? What is it? What is it? Come on. I got one answer. I'm waiting for others. I got two answers. Waiting for others. Shailendra, Nidhi Deshpande. Come on. Where do you think? Sumit Jain, Aniket Jain. Okay. Manini has given an answer. Okay. Good. Good. Aniket, Sumit Jain, give me an answer. Okay. What is NCI? Sir, NCI is an entity which is holding shares in the subsidiary. It is an entity which is holding shares in the subsidiary. Shares means equity shares. Equity shares means it is equity. Equity means they are entitled to residual interest in the subsidiary. They are entitled to residual interest in the subsidiary. And since they are holding equity, I am under no contractual obligation to deliver cash. I am under no contractual obligation to deliver cash, and therefore I will have to show it under equity. I will have to show it under equity. Basically, वो भी तो हम let us understand कि भाई consolidation में क्या होता है. See, I have P, I have S. So essentially, I will be adding P plus S. So since I will be adding P plus S, therefore, the NCI will be a part shareholder, yes or no? It will be a part shareholder of S. And since it is a part shareholder of S, it is going to get only a residual interest. It is going to get only a residual interest in the shares of in the assets of the consolidated entity, and that is why we present it under equity. We present it under equity. Is it okay? Yes. Are we totally, completely, 100% absolutely clear with NCI? Yes. Totally 100% clear with respect to NCI? Yes. I hope there is no doubt whatsoever. NCI is all clear. Fine. तो ये सब कहानी के बाद you have written the heading step 5 NCI. Let us write some pointers for that. Non-controlling interest, where control is acquired in a holding subsidiary relationship at less than 100% stake. NCI needs to be created. NCI needs to be created in the consolidated accounts. In the consolidated accounts. Since control over subsidiary gives the parent the ability to direct the relevant activities for 100% of net assets of the subsidiary, comma, the net assets of subsidiary will be taken over at full values. That is 100%. That is 100%. Therefore, NCI needs to be created for the share in net assets that do not belong to the parent. We discussed this 20% stake. Ind AS 103 permits measurement of NCI on the date of acquisition by either of the following two methods. First one, NCI at fair value. How do I measure number of shares held by NCI multiplied by market price per share of the subsidiary. This method can be followed only if market price or fair value of the subsidiary is given. The goodwill arising in this case would be attributable to both parent and NCI. That is full goodwill. Okay. Second one, proportionate net assets method. NCI on date of acquisition is equal to fair value of net assets of S on date of acquisition multiplied by NCI stake. In exam, always follow this method unless market price or fair value of the subsidiary is given. What will be the goodwill in this case? Attributable only to the parent. The goodwill arising in this case would be attributable only to the parent. That is partial goodwill. Okay. All right. Noted. classification and presentation. NCI will be shown as a separate line item as a part of equity and not liabilities. This is because NCI is also represented by equity shareholders in the subsidiary who have a residual interest and there is no contractual obligation to deliver cash. There is no contractual obligation to deliver cash. Okay. Done? Okay. NCI just so that in exam time you need not read the whole note. Fair value method of net assets method. This will give rise to fair value, not valued. Partial goodwill. Okay. ये हो गया हमारा full goodwill, partial goodwill. Okay. And then I will just give a small point that many of you would start drawing parallels with AS14. So AS14 के case में the goodwill was basically PC versus net assets. उसमें NCI था नहीं because S Limited would close down immediately after. So therefore you would not have an NCI there. Okay. So I hope you've noted this part. It's basically a summary of what we have. Okay. In amalgamation or absorption in intermediate, goodwill was the difference between PC and net assets. PC and net assets. No NCI was considered because the selling company would shut down. 100% would be merged or absorbed into the purchasing company, resulting in no NCI. Resulting in no NCI. Okay? So that takes care of step number 5. Thank you, Kaushiki. Okay, so that takes care of step number 5, and finally सारा चीज करने के बाद, सब कुछ करने के बाद हम लोग एंड में पहुंचते हैं अपने मंजिल पे, दैट इज गुडविल कैलकुलेशन. That is goodwill calculation. After all this, we come to the last step, that is goodwill calculation. The final destination of Ind AS 103 ends at this stage, that is goodwill calculation. ये पूरे standard का final end point यही है, that is all the hard work that we have done and that we will be doing in the future. I told you step number 4, we still have a couple of points to discuss. So all of this is related to ensuring that the goodwill is determined correctly. The goodwill is determined correctly. Okay. Now, what do we mean by goodwill? We all know now. It's fairly gone in our brain that goodwill is going to be nothing but, if you look at, don't write down now, don't write down, please pay attention. Net assets account debit to purchase consideration to NCI. So this would give rise to goodwill. This would give rise to goodwill. So the same thing, if I put it in a equation form, I could say that purchase consideration plus NCI minus net assets would be giving you goodwill. Would be giving you the goodwill. Same cheese hai, it's exactly the same. Net assets account debit to purchase consideration to NCI. The difference would be the goodwill. Okay, so you could do it in the form of this journal entry or in the form of this equation. This is how it is going to be. Okay, now I will just complete this step and then we'll take a break. Okay, I'll be extending your class by about half an hour to 1 hour at least. Okay, because there is lot to discuss. We still have to come to common control combinations, and then demergers are there, and then that reverse acquisition is there. I don't know how things will pan out. Okay. Anyways, we have the next 6 classes also left with us. Okay. So in consolidation, I'll see if I can just chip in some of these topics. Okay. Now, when you look at this, the final figure is goodwill. Goodwill will be a positive figure generally. Goodwill will be a positive figure generally. But the standard gives the word of caution. Okay. See, Ind AS 103 comes from IFRS 3. Okay. That deals with business combination. So basically, if you look at the text, it's exactly the same. It's exactly the same. There is no change even in the text, in the para number, nothing. We have certain carve outs and carve-ins. Okay. So that is IFRS minus the carve out plus the carve-in is equal to Ind AS. Okay, so that is how the regime is. Now coming to IFRS 3, What it tells is, if it is this PC plus NCI minus net assets, if it is a positive figure, fine, we are happy. I mean, we assume that you have done the net assets, PC, everything at fair value. We are happy. If the goodwill, if the figure is a negative one, that means in this journal entry, it comes on the credit side as a balancing figure. Agar wo baat hai, IFRS 3 and Ind AS 103 puts a word of caution. It tells us that if you get a negative figure, please carry out the entire evaluation process once again. Please carry out the entire evaluation process once again. Sir, क्या-क्या evaluate करोगे? Starting से लेके end तक सब evaluate होगा. Identify whether you have computed the purchase consideration correctly, whether you have calculated the non-controlling interest correctly, and whether the net assets taken over are measured correctly. So basically you will be measuring, you will be performing step number 3, step number 4, step number 5 all over again if you get a credit figure in the journal entry or a negative figure in the equation. Okay. So agar ye baat hai, then you will be having a second round of review or reassessment. You will have a review or reassessment. Sir, why is that so? Dekho, see, this is a very, very interesting scenario. Jahan pe you are making a profit. You would have heard this or not, I don't know. But a business acquisition under IGAAP or Ind AS, it is one of the rarest of the transactions where you end up making a profit or a loss on purchase of something. See, ideally you make a profit or loss on sale, but this is one of the very few transactions where you end up making a profit on account of purchase. Sir, आप profit on purchase कैसे बोलते हो? See, you are giving some money. In exchange for that money, you are getting some net assets. You are paying some value. In exchange, you are getting another fair value. The difference is going to give rise to a profit or a loss. Loss means you have paid more, you got less. So that goes and sits in your goodwill, and Ind AS 103 is fine with that, because more often than not, you are acquiring a running business. So running business will have some goodwill in the market. It will have some goodwill in the market. So some prepayment is perfectly fine. But if you pay and you get more than what you have paid, by that is an abnormality. That is abnormal. You are getting more than what you have paid for. Suppose you pay 100 and you are getting the fair value of 120. Bhai, that is very abnormal. See, why are you going to get more than what you have paid? Your purchase consideration is at fair value only. Cash, equity, deferred consideration, contingent consideration, pre-combination allocation of awards, existing stake. You take any of the 6 parts of the PC, each and everything is at fair value. So if that is the case, why am I getting more than the fair value of what you have paid? Understand from a simple buyer and seller perspective. Bhai, when you go to buy an iPhone or any gadget, so iPhone is, say, suppose 70,000 rupees. You pay 70,000, you get a phone worth 70,000. It is not going to be the case that you pay, say, 20,000 for an Android phone and you get 70,000 iPhone in exchange. That is something which is highly abnormal, right? So that is what even IFRS 3 standard setters felt, that if there is a negative goodwill, that is a capital reserve, what we know, you will have to perform the review or reassessment all over again, because the intent of the standard setters is that capital reserve nahi ho sakta. Capital reserve, most of the cases will not be there. It will end up being goodwill in most of the scenarios. Capital reserve hoga, review and reassess again. IFRS 3 जो credit figure आता है, if suppose you got a credit figure as a balancing figure, IFRS 3 permitted you to put it in the profit and loss account. Straight away, you take it as a gain on bargain purchase and put it in the P&L. Ind AS 103 gave a carve out to this. उनको पता है, इंडिया में पता है, लोग अगर P&L का ऑप्शन दे देंगे तो कैसे भी करके फिगर डालेंगे P&L में. So Ind AS 103 came out with a carve out. Okay, what Ind AS 103 tells? See, if you know the reason for the negative acquisition, if you know the reason for the negative goodwill, sir, why will I have negative goodwill? Dekho, two things can happen. First one is the net assets that you have acquired are very low. Why net assets will be very low? Probably it could be a case of forced sale or a distress sale. Okay, the owners of the selling company just want to dispose of their interest, and therefore they are willing to get rid of the company by the very first buyer that they acquire it from. So if that is the case, the net assets will be very low. The PC is at fair value, and the PC will be low and the net assets will be at fair value because you have paid a distress value, whereas the worth of the assets is far more than that. This is giving rise to a negative goodwill. This is giving rise to a negative goodwill. The second case could be, there has been a fraud in the case of the company. There has been a fraud in the case of the company. By virtue of that fraud, the price of the shares has come down to a all-time low, and you acquired the price. You know the net assets worth is how much in general. So therefore you have acquired the shares at a very low purchase consideration, which has given rise to a negative goodwill. If, like these two examples, you know the scenario why you have paid less. In such a case, you can show the negative goodwill as a gain on bargain purchase, under other comprehensive income, And from other comprehensive income, you will route it straight away to the capital reserve. See, your statement of total comprehensive income is the first thing you are going to review as a reader of financial statements. Notes words to baad ki baat hai. When you look at other comprehensive income, the reader will automatically see in other comprehensive income gain on bargain purchase. That means he will then automatically move to your notes to see why this gain arose, etc. So the impact of items appearing on the face of other total comprehensive income is huge, because the reader will be interested in knowing each and every item appearing at least on the face of total comprehensive income. But suppose bhai mere ko reason I don't know why this turned out to be a negative goodwill. I cannot really understand. I cannot really decide why I got a negative goodwill. If that is the case, then what the standard tells is, don't show it as a gain on bargain purchase. You will directly credit it to the capital reserve. No, it won't come under other comprehensive income. It will directly go in capital reserve in the equity, in the other equity component. Okay, so that is what is there about goodwill. Okay, so we'll just quickly write small notes about this, and then we shall proceed for the break. Okay, so goodwill calculation is nothing but PC plus NCI minus net assets. Okay, if this is positive, or if you talk in terms of entry, debit balance, then this goes in goodwill. Ideally, it's fine. No recheck, reassessment, nothing is needed here. If it is negative, that is credit balance. If it is a credit balance, the standard setters recognize that this is extremely rare. And since it is extremely rare, what the standard setters tell is you review, reassess, the fair value of PC NCI net assets. Reassess. उसके बाद भी if it comes negative, then you answer these questions. Are any reasons attributable to the negative figure? Example, distress sale, fraud, in selling company, etc. If you know the reason, then you will record it as gain on bargain purchase. And where are you going to show it? Other comprehensive income. And from there, it will ultimately flow to capital reserve. Okay. So other comprehensive income. Under IFRS 3, this would go to profit and loss. This would go to profit and loss. Okay. But can you have no reasons also? Yes. If no reasons are attributable to the negative figure, what are you going to do? Credit directly credit the capital reserve. Directly credit the capital reserve. Okay. Is it fine? Have you guys understood goodwill? Yes. Okay. So we take a break of about 5 to 7 minutes. We resume at 9:10. Okay. I'll be extending the class. So please be prepared. So get properly refreshed for your session. I'll be taking a 5 to 7 minutes. 9:10 we shall resume. Okay. All right. Ayaz. Okay, all right. Okay, so welcome back. We shall now discuss couple of other things in this chapter before proceeding. Soham, I don't think I have the option for an extra class. You can proceed for the day. You can view this session later on. Okay, it'll be fine. I mean, the most important part is already done. Okay, so now whatever is there will be fairly simple as compared to what we have already discussed. Okay, so you can review it later on, not an issue. And I'll be covering some portion of this later on in the consolidation portion also. Okay, so that should be fairly simple at that point of time because we'll be understanding some other topics. Okay, all right, so that takes care of the 6 steps. Now coming to certain special adjustments. Okay, uh, I don't know how to take. Have you guys studied deferred tax Ind AS 12? I don't think this batch has done Ind AS 12, right? I am not very sure. Just let me know. Have you done Ind AS 12? Mostly may not be the case. Okay, fine. All right. Okay, so we have 2 special adjustments. Okay. First one is deferred tax adjustments. Deferred tax adjustments. Okay. At the time of business combination. When will I give this impact? To be done at the time of step 4. Okay, so when you are calculating net assets, this will be done. Okay, typically this direct adjustment will not be given. They will not tell you calculate the deferred tax impact also. They will give you 2 pieces of information. The first one is fair value of net assets taken over as well as the book value of net assets taken over, and they will also be giving you the tax rate. If these 2 things are there, understand that this is going to be a deferred tax calculation which you will have to perform. Okay. This adjustment needs to be done only if 2 pieces of data are given. A, fair value of net assets taken over and carrying value old of net assets taken over is given, and B, tax rate is given. Tax rate is given. If these 2 things are there, then deferred tax will be triggered. Typically, I mean, it's very rare that you get these adjustments. Okay, in your entire study module and whatever questions are there, only 2 to 3 questions had a deferred tax calculation. Only 2 to 3 questions had a deferred tax working. Okay, so now coming back to the adjustment. Ki bhai, what is the adjustment? You can write down. Deferred tax is equal to difference multiplied by tax rate. What is the difference? We will explain that. That is nothing but the difference between the fair value as well as the carrying amount. The difference between the fair value and the carrying amount. In दोनों के बीच का जो difference है, that is known as, in दोनों के बीच का gap, we call that as difference. Since you have not studied Ind AS 12, don't ask why is it a DTA, why is it a DTL. वो सब you will understand it when you do deferred tax. Okay. Fair value is greater than carrying value. Then this gives rise to a deferred tax liability. Fair value less than carrying value. This gives rise to a deferred tax asset. Why or what I can explain only when we do Ind AS 12. Okay. So whoever teaches you Ind AS 12, the moment they teach you Ind AS 12, please revisit this particular note for an understanding. Okay. For an understanding. All right. So difference refers to the difference between fair value of net assets and carrying value of net assets. Carrying value of net assets. Okay. Impact on business combination. Steps 1 to 3, no change. Step 4, net assets. How am I going to calculate this? Fair value of net assets taken over less deferred tax liability, add deferred tax asset. Okay, so this changes your net assets. Fair value of net assets taken over after tax. Okay. Now tell me step number 5, NCI. Step number 5, NCI. Will it change or will it not change because of this? Step 5, NCI. Will it change or will it not change? It will change only if NCI is at proportionate share of net assets. If NCI is at fair value is based on market price. Market price का इससे क्या लेना देना? Nothing is there. Okay. So the market price, if NCI is at fair value, that won't change. If NCI is at proportionate share of net assets, then it will undergo a change. Okay. So yes, absolutely right. So at fair value, no change due to deferred tax. No change due to deferred tax. Proportionate net assets. This will change. Net assets after tax multiplied by NCI stake. So since this is changing, this also will undergo a change. Okay. This also will undergo a change. Okay. Fine. So that I hope you have noted this part. Noted? Noted? All right. So now coming to the next adjustment. You remember long ago, we had done something known as replacement awards, right? I had given you the example of L&T and Mindtree, I suppose. Yes, I had given you the example of L&T and Mindtree. Yes, I had given you the example of L&T and Mindtree. And then I told you that L&T replaces, by issuing new awards, it replaces the existing award of Mindtree. And then we had seen how the calculation was done, etc., etc. Now, let us assume in the same example, the employees of Mindtree will tell that I don't want your award. I want to continue with Mindtree award. Whatever you do, whatever price you offer us, whatever fair value you give us, we will not change our loyalty. We want to continue to be shareholders of Mindtree only. We will not become shareholders of L&T. So these are known as non-replacement awards. Because Mindtree had an existing stock option plan prior to acquisition. And after acquisition also, the same awards are continuing. That means Mindtree will continue to have these awards without getting it replaced from Larsen and Toubro. So now you tell me one thing. Once these options vest and start getting exercised, sir, which award? Non-replacement awards. Once these options start getting vested and the employees start to exercise those options, that employee will become a shareholder of which company? Will he become shareholder of Mindtree, or will he become the shareholder of L&T? Will he become the shareholder of Mindtree, or will he become shareholder of Larsen and Toubro? He will become a shareholder of Mindtree. So Mindtree mein who are the shareholders? L&T will be the major shareholder, and these people will go on getting added as non-controlling interest, will go on getting added as NCI. You remember? So therefore, if you remember replacement award, the employees would become shareholders of Larsen and Toubro. The employees would become shareholders of Larsen and Toubro. And because they would become shareholders of Larsen and Toubro, what entry I used to pass? I used to credit SBP reserve because I was in the books of Mindtree. I used to pass the entry employee benefit expense account debit to SBP reserve. And on the date of acquisition, I would be crediting the SBP reserve because L&T is replacing Mindtree's awards with its own awards. In the case of non-replacement, L&T is unable to replace it. मतलब Mindtree का award अपने आप चलता रहेगा. It will go on getting continued. So now you tell me, in the consolidation time, what do we do with these non-replacement awards? I cannot credit SBP reserve because these awards do not belong to L&T. Instead, I will be crediting non-controlling interest. I will be crediting non-controlling interest because the shareholders on exercising the options, the employees on exercising these options will become shareholders of Mindtree. And if they become shareholders of Mindtree, their stake goes up. That is, whose stake goes up? The NCI's share starts to go up. Is it understood? Yes. NCI share starts to go up. Is it okay? Yes. Sir, calculation will be exactly the same. There won't be any change in calculation. Only thing is, at the time of the entry, whatever credit was going to SBP reserve, instead of that, it will go to NCI. Have you understood? Yes, it's exactly the same as we've done quite a bit today. Okay, exactly the same as the entry in replacement awards, except for that small change. In this case, comma, ESOP scheme of S continues as it is. Accordingly, ESOP holders will continue to get shares of S. Arises in holding subsidiary relationship arises in holding subsidiary relationship. Accounting for non-replacement awards. Non-replacement awards. ESOP holders of S are also owners equity of S, where P does not replace the scheme of S by its own ESOP schemes, comma, where P does not replace the scheme of S by its own ESOP schemes, it gives rise to NCI as ownership interest is not acquired. As ownership interest is not acquired. Okay. Have you noted this part? Have you noted this part? See, ownership interest means by virtue of these awards, I'm not going to get additional stake. In fact, it is NCI who is getting the stake. Okay. So in the case of L&T issuing its awards, I was crediting SBP reserve. I was not crediting NCI. Here I am reducing my ownership stake. Okay. Because NCI starts to get increased. So that is why ownership interest is not acquired. Okay, the stake percentage, not the control, not the control. Control to hai hai. Ownership interest arises na, you are holding shares in the case of a holding subsidiary. So there is an ownership interest. Ownership interest means you are owning the subsidiary by way of acquiring its shares. Okay. It gives rise to NCI as ownership interest is not acquired. The principles calculations for valuing pre-combination and post-combination portions would be same as replacement awards. However, instead of crediting SBP reserve, NCI would be credited. NCI would be credited. Okay. Fair value of existing awards on acquisition date. Pre-combination allocation. This is going to be part of NCI. So entry will be net assets of S debit show it as SBP reserve, cancel and write it as NCI. So you know that the difference is only in the last item. Okay. Post combination allocation. Remuneration cost, employee benefit expenses over remaining vesting period. EBE debit to SPP reserve. Cancel this and in its place write NCI. Okay, so that takes care of non-replacement awards also. Non-replacement awards also. Done. See, there was nothing to explain because calculation we've already dealt with in great detail in the last class. Okay, so calculation is exactly the same. Only thing is instead of SBP, it will go to NCI. That's the only thing which is separate. Okay, otherwise it is exactly the same. Okay, so now this is done. Now we move on to the next part. That is, see, I will see now what all is remaining. Okay. Asset measurement period is important. Okay. Okay, fine. Many things are there. From where do we start? 6 should be taken over. Okay, fine. Components of purchase consideration. Components of purchase consideration. Okay, so now let us in this part discuss a special point known as composite consideration. Let us discuss a point which is known as composite consideration. Okay, what do you mean by composite consideration? See, it is quite possible that There may be an existing relationship between the parent and the subsidiary prior to acquisition. There may be an existing relationship between parent and subsidiary, which would be get settled as a part of the business combination. For example, let us take two companies, parent P and S. P and S. Prior to acquisition, the parent P had prior to acquisition, P had filed a suit. P had filed a suit on S for infringement of copyright. Let us just take it as an example. P had filed a suit on S for infringement of a copyright. And as a result, the case is going on. As a result, the case is going on. Okay. Now, in the course of pendency of this case, the parent company also made an offer to acquire S, and S very willingly gave ahead its go ahead and said that we will agree to the acquisition by P. We will agree to the acquisition by P. Okay. Now, let us assume that the purchase consideration is 500, whereas the damages sought is 50. The damages sought is 50. So total payment that will be made is 550. Total payment that will be made is 550. Now the question that arises is, can this entire 550 be regarded as a purchase consideration? See, given a choice between P and S, it does not really make a difference whether damages are charged or not charged, because on a consolidated level, ultimately damages will be income for one, expense for the other. It would ultimately get nullified. But you tell me, see, the shareholders of S are very particular about getting these damages, because the shareholders of S will also include certain NCI shareholders also who want these damages, because unnecessarily the company's profitability is going down. So the damages are being paid by P to S. Only thing is, it is not called as damages. Instead, the word used is P is going to pay 550 to S. In exchange for so and so shareholding or whatever it is. Okay. So now you tell me whether 550 is correct to record as PC, or whether it would be correct to record what you can say 500 as PC and 50 as damages. How would you prefer to go ahead with the accounting? Would you want to show 550 as PC, or would you want to show 500 as PC and 50 as compensation loss? What do you think? Yes, all of you are correct. The PC is actually 500 only. 50 is your damages, which could go ahead as capital, which could go ahead as a compensation loss, which will start to hit the profit and loss account, which will start to hit the P&L. Is it okay? Yes, is it fine? All right. All of you gave the answer as 500. Okay. Let us assume that the subsidiary has made a provision of 40 rupees. And you got a liability of 50. So the entry will be provision account debit 40 to bank 50. Ultimately, the balancing figure is going to be 10, which is your compensation expenses. Is it okay? Yes. All right. So that takes care of these type of relationships. Okay. So now coming back to components of purchase consideration. There might be an existing relationship between P and S prior to business combination. Prior to business combination. Which may get settled as a part of business combination. Ind AS 103 requires separation of PC and non-PC elements. Requires separation of PC and non-PC elements and recording of the same should be done separately. Recording of the same should be done separately. Non-contractual lawsuit. What is happening? Fair value. Licenses. Lower of fair value less carrying value or okay. All right. So just copy this. It won't be of much importance. Okay. In case it is a contractual relationship, you will record it at lower of fair value, less carrying value or settlement value, which is damages as per the contract. Okay. So this is nothing much to discuss. It's fairly simple. Okay. It's largely theoretical in nature. Okay. All right. Okay. These are just some points which are there in the standard and in your problems. You can just go through it. I would ideally want you to solve the problems. Okay. We don't have the luxury of solving the problems because of lack of time. Okay, consolidation will be purely problem solving because that is how it will flow. But these topics is this one topic I need you guys to solve the problems by yourselves. Okay, coming to the next one. See, contingent payment linked to future employment. See, suppose you are having Yashraj Films. Okay, suppose you are having a company like Yashraj Films, and Yashraj Films acquires AB Corp Limited. Okay, Amitabh Bachchan Corporation Limited, and when it acquires Amitabh Bachchan Corporation Limited, it comes with a condition that ABCL will always remain as an employee of ABCL or as an employee of YRF. Okay. And for that, we are going to make the payment. So the terms of the purchase, the shareholders purchase agreement is going to be like this. Okay. It is going to be like this. The terms will be, see, Yashraj is paying 550 rupees to ABCL on account of the acquisition. But when you go deeper into the agreement, you will see that 500 is for the net assets, 50 is for the payment on the grounds that Amitabh Bachchan will always continue to serve as an employee of ABCL or as an employee of YRF. Okay. So in this case, we are having a payment. We are having a payment that will be in the nature of employment. That will be in the nature of employment. So when payment is made in the nature of employment, see, in ABCL, the prime shareholder is Amitabh Bachchan. But now you want him to be employed in your organization or within the group, and for that you are making an extra payment of 50. So now you tell me, is this payment of 50 rupees which is being made, is it made to Mr. Bachchan in the is it made to Mr. Bachchan in his capacity as a shareholder, or is it made to Mr. Bachchan in his capacity as an employee? Tell me. 550 may say 500 is on account of the net assets acquired, and 50 is on account of him to remain in service. So now you tell me, is the extra 50 that is being paid, is it in his capacity as a shareholder or is it in his capacity as an employee? What do you guys think? It is in his capacity as an employee. So 500 will be the PC, no doubt about that. But the additional 50 which is being paid, it is linked to the condition that Mr. Bachchan should remain in the employment. And if that is the case, then what will happen is that you cannot take that 50 as a purchase consideration. It will be treated as a part of employment. It will be treated as an employment cost. It cannot be treated as purchase consideration. Is it okay? Yes. So now contingent payments linked to future employment. Such payments will always be regarded as employee benefit expenses. Will always be regarded as employee benefit expenses and not as PC, not as purchase consideration. Is it okay? Yes. All right. Now, sir, it is like composite consideration. Yes, it is like composite consideration, but we will have to split it. We will have to split it. Okay. Composite is where you make a single payment, but the purpose of that is multiple uses. Okay. So it is like a Composite consideration, yes, and not as PC. You will book it as an expense over the period of the contract, Okay. Is it okay? Done. What is paid in the capacity of shareholder will be taken as PC. What is paid in the capacity as an employee will be regarded as remuneration expense to be expensed out over the remaining acquisition period. Okay, so that takes care of future payments in the nature of employees. Okay, fine. Now, okay, coming to net assets taken over. Net assets taken over. We are discussing some extra items now. I told you we will be discussing some things later on. So those things we are now discussing. So now in your net assets taken over, we will be discussing certain special cases. Okay. Now see first case. Please pay attention. P has an option to acquire S1. P has an option to acquire S2. In S1's case, net assets is 100. In S2's case also, net assets is 100. But along with S1, there is a contingent liability. There is a contingent liability. An IT case is going on. An income tax case is going on at present. P is looking at acquiring either of S1 or of S2. Now tell me, do you think the purchase consideration will be the same for S1 and S2? Or do you think it will be more for S1, less for S2? Or do you think it will be more for S2 and less for S1? Come on. Just give me a minute, please. Give me a minute. Just think about this. I'll be back in a minute. Okay, sorry for that. So now, will the consideration be the same for S1 and S2, or will it be different? Okay, so I'm getting answers. It will be different. Typically, the consideration will be more for S2 is what you are telling, and less for S1. Okay, so that is what you are telling. Okay, so Aniket Jain is also okay. All right. Shailendra is saying it will be the same. See, typically, if you look at S1, S1 is not a clean company. Clean in the sense, what I'm not saying fraud and all. S1 comes with a baggage of this contingent liability. S1 comes with a baggage of a contingent liability. That, why has it put it under contingent liability? Because it meets the conditions of a contingent liability. The case is yet to be heard. Decision is yet to be taken. The probability of an outflow is remote. The probability is less. Okay, we are likely to win the case. So all these conditions which are outlined in Ind AS 37 make S1 consider it as a contingent liability and give it as a disclosure. But S1 comes with a baggage. S1 comes with a baggage. S2 के case में it is a clean company. There is no pending income tax case, no contingent liability, nothing. So it is just going to be net assets of 100. So when P has to take a call to acquire S1 or S2, it will obviously factor in one thing. वो एक चीज जरूर सोचेगा, which is S1 has a contingent liability. S1 has a contingent liability. कल के तारीख में, if this case hearing comes up, there is a small chance, वो भले ही कितना भी छोटा हो, there is a small chance that S1 will lose the case and I will end up with a liability. See, S1 के पास ही liability रहेगा, but ultimately S1's liability is belonging to the group only, no? So if a liability does arise in the future, it will be a loss for S1, and loss for S1 means a loss for P also. So therefore, ultimately P will think in this perspective, and therefore between S1 and S2, P will obviously give a higher consideration to S2 and a lower consideration to S1 and a lower consideration to S1. That means in true sense, when S1 is getting acquired, it is not only the net assets, but it is also a contingent liability that is getting acquired. It is not only the net assets, but it is also a contingent liability that is getting acquired. And therefore, Ind AS 103 tells, perform a fair valuation of the contingent liability. Perform a fair value of the contingent liability. And you will get some value. वो भले कितना भी छोटा क्यों ना हो, whatever be the value, show as a liability acquired on date of acquisition. But sir, this is contingent. Agreed. But it is creating a difference in purchase consideration. That means you know for sure that there is a small chance that this contingent liability may materialize. So therefore, you perform a fair valuation of the contingent liability and show it as a liability acquired on the date of acquisition. Why can you not show it as PC? Because this amount that will be payable to the contingent liability is payable to the income tax department, which is not a shareholder or an NCI. So therefore, it will not be a part of PC. It will not be a part of PC since it is payable to some third parties entirely, and it is not payable to the shareholders. It's not payable to the shareholders. But you will continue to recognize it as a liability in the consolidated balance sheet. P, assuming you are acquiring as a form of a subsidiary, Amalgamation absorption, if that was the case, then the contingent liability would come in the books of the parent company, the standalone books, okay, of the purchasing company. So this is how you are going to record. So initial recognition will be as a liability, which will be reduced from the net assets that you have already computed. Okay. So first case, you can give the heading contingent liability. Initial recognition on date of acquisition. I will apply Ind AS 103. Part of net assets taken over. That is step 4. Not part of PC, since it is payable to third parties. And not shareholders. To be included at fair value on date of acquisition. Irrespective of whether probable or not. Have you understood initial recognition? Means balance sheet mein you will be having it as an actual liability, not as a contingent one. Actual liability. Entry pass hoga iska. Credit will come. In the takeover entry, you will have net assets account debit to purchase consideration to contingent liability payable. You will be having an actual liability that is booked in the consolidated books, consolidated statements. Have you understood initial recognition? Yes. Kaushiki, Aniket Jain, Sumit Jain, Manini, have you guys understood initial recognition? Yes. Have you guys understood initial recognition? Yes. But now coming to subsequent recognition. That means at subsequent balance sheets. See, subsequent balance sheets, Ind AS 37 will apply. Now, how to get what Ind AS 37 tells? Well, Ind AS 37 tells if the probability is, if there is no likely possibility of a liability materializing, and it is dependent on future events, if that is the case, then you will have to show it as a contingent liability. That means on the date of acquisition, you have recorded an outflow which is not likely to happen. So what Ind AS 37 tells? Then you immediately reverse it. You will not record that liability.
Bhai, this is something which is very wrong. Na? 103 tells us book a contingent liability, whereas Ind AS 37 tells us you reverse it because it is not a liability in the first place. It is actually going to be a contingent liability. So Ind AS 37 ke hisab se it meets the definition of a contingent liability. You cannot show it as a liability. You reverse the liability recognized. That means if you follow Ind AS 37 and 103 in this fashion, you will never ever be able to recognize the contingent liability as a liability, because 37 will always lock horns with Ind AS 103 in respect of the recognition criteria of the contingent liability, in respect of the recognition criteria. So therefore, Ind AS 37 has come out with an exception. Ind AS 37 came with an exception that in the case of a contingent liability which is recognized as a liability in accordance with Ind AS 103 guidelines, till the date of settlement, at each balance sheet date, you will record the contingent liability at higher of the liability originally recorded on the acquisition date, or the liability determined as per Ind AS 37, as per the liability determined under Ind AS 37. So, till the date of settlement the contingent liability at each balance sheet date should be recorded at higher of first one, liability recorded on date of acquisition, or if this liability increases, so liability determined as per Ind AS 37. As per Ind AS 37. So till the date of settlement, the contingent liability should be recorded at higher of liability on the date of acquisition, or liability determined as per Ind AS 37. Because if I simply did not have this exclusion clause, I would book a liability on the date of acquisition and immediately next day I would reverse this liability because it is not a actual liability, it is merely a contingent one. But now we have received this guidance, so therefore you will continue to have this contingent liability getting recorded as a liability in the consolidated books. Is it okay now? Yes. Are you able to follow? Nidhi, Manini, Kaushiki, Srishti, are you guys able to follow? Yes. Okay, fine. Aniket, Jain, all are clear. Okay. Now, it may so happen that I build up on the same example. S1 has a former parent S. Okay. S1 has a parent S prior to acquisition by P. So what S tells is, look, if you take over S1, whatever be the outcome of this income tax case, I will compensate you for that. So whatever be the outcome of the income tax case, kitna bhi demand aane do, I will be compensating you for that. I will be compensating you for that. So, in other words, can I say that the former parent is indemnifying? Can I say that the former parent, I'll come to your query, Manini. Okay. So, can I say that the former parent is indemnifying the new parent with respect to the contingent liability of S1? Can I now say that S is indemnifying P to the extent of the contingent liability? Yes, he is. And therefore, can I now say that this is creating rise, this is giving rise to something known as a contingent asset? This is giving rise to something known as a contingent asset? Yes. Can contingent assets be recognized in the balance sheet? Can contingent assets be recognized in the balance sheet? Answer is no. Answer is no. But since in Ind AS 103, you are recording a contingent liability, you are recording a contingent liability, you are also going to record the contingent asset in this case, the contingent asset. Practically, Ind AS 103 ends up shaking a lot of your accounting concepts. पहला goodwill था, वो थोड़ा सा ऐसे ऐसे हिल गया. Contingent liability never recorded is now coming in as an actual liability. Contingent asset तो कभी दिखाते भी नहीं थे. Now that is actually going to come in as an indemnification asset in your balance sheet. Okay. So 103 makes a very, very huge change in our understanding of how accounts should be prepared. Why is that so? Because see, Ind AS regime is focusing more on being practical in terms of financial reporting. You cannot take the flag of conservatism and not record anything, because if you are extremely conservative, the fact is your true and fair view starts getting affected. Because on account of extreme conservatism, what you will end up doing is you will end up doing 4 things. And all these 4 things have one effect only. What are the 4 things? You will understate your assets. You will overstate your liabilities. You will understate your incomes. You will overstate your expenses. All these four things you will end up doing on account of conservative. And because you end up doing these 4 things, what are you going to give a true and fair view about? Your results will be grossly understated. Your net assets will be grossly understated only on account of the fact that I stuck to a conservatism principle. So therefore, conservatism is not a principle under Ind AS. What is a principle is realistic accounting. What is a principle is a realistic accounting. In fact, when you study Ind AS 115, or you would already have studied Ind AS 115. In Ind AS 115, there is a concept of incentive that will be available on, say, early completion of a contract. Incentive available on early completion of a contract. What 115 tells us, if you are having the chance of completing the project within the specified time limit, then please include that in your revenue right from day one and estimate it over the life of the contract. It is a contingent event. Okay. The chance of earning the bonus depends on how you can complete your task. But I am being realistic and saying that I have the work to complete this particular project, and therefore I will stake a claim for getting the what you can say. I will already stake the claim for getting the incentive, and I will record my revenue with the incentive. If it had to be AS 9, we would recognize the incentive say in the 5th year when the project is actually getting completed. But right now, every month, every year, we will be recognizing a proportion of the incentive that is already going to be recognized by me. Is it okay? Did you understand? So therefore, Ind AS moves to a more realistic form of accounting. It's not just conservatism, it is realistic. So therefore, in that sense, in that realism also, we now have an indemnification asset that will be recorded. We now have an indemnification asset that will be recorded. Is it okay? Yes. Have you guys understood? So this is contingent liability. Okay, net assets taken over, special cases. Second one. Are have you understood? Okay. Kaushiki, yes. Okay. So now indemnification asset. Indemnification assets. These are reimbursement rights. These are reimbursement rights or in respect of contingent liabilities taken over. They will be recorded as a part of net assets taken over. As a part of net assets taken over on the date of acquisition on the same basis as the liability for which indemnification is given is recorded. Thus, indemnification asset is measured at lower of wait, not this part. Thus, indemnification asset will be measured after considering the actual liability to be the same as contingent liability to be recorded. All right. So you will continue to record, though Ind AS 37 does not allow recognition of indemnification assets. The recognition in this case is governed by Ind AS 103 and not by Ind AS 37. So suppose the contingent liability is say 100 and your indemnification contract says whatever is the contingent liability, we will indemnify it. So you will recognize the contingent liability at 100 as well as the indemnification asset at 100. Suppose they say that whatever be the liability, we will be we will be reimbursing only 100 to you. So suppose the contingent liability has a fair value of 80, you will recognize indemnification asset of 80. If it is 90, 90. If it is 100, 100. If it is 110, they have told they will reimburse only up to 100. So indemnification asset will be 100, contingent liability will be 110, and so on and so forth. Okay. So the actual liability to be the same as contingent liability to be recorded. Recognition of indemnification asset is governed by Ind AS 103 and not Ind AS 37. This is very important because when you study Ind AS 37, you may end up getting confused between both of them, saying that 37 to mana kar raha hai, then how 103 is recognizing an indemnification asset. Okay. And not Ind AS 37. And hence will be recorded irrespective of the fact that it is virtually certain or not. You can recognize an asset under Ind AS 37 only when it is virtually certain that you are going to receive. But यहाँ पे वैसा कोई संबंध नहीं है. Okay. Subsequent recognition at each balance sheet date indemnification asset continues to be recorded on same basis as the liability recorded on that date. Okay. So fairly simple. Khali asset liability you will have to record, difference will go to goodwill or capital reserve. Okay. If you don't record these two things in your business combination, then there is a chance that your goodwill or capital reserve that will be calculated is going to go incorrect. Have you understood? Yes. Is it fine? Yes. Have you guys understood? Bolo Aniket Jain, Manini, Kaushiki, Srishti, Nidhi Deshpande, have you guys understood? Yes, it's fairly, I mean, if I had a chance, I could do it with numbers, but abhi I'm very hard pressed for time. So I'm kind of rushing through the small concepts. I don't know how to complete some things. Okay. All right. Now, there is a last concept that we will do before we move on to common control combinations. Okay. I'll see. One day I will have to request. Okay. Okay. See, now this is the last concept under Ind AS 103. Okay. Then we have common control combination, which is appendix to Ind AS 103, which I will be dealing with it later. Okay. So I have not done great deal of problems the way we had done in the earlier chapters. The reason being, I will cover quite a number of problems in consolidation. Consolidation may it will be only problem solving, not great number of notes that we will be writing. So there I hope I can cover a fair bit of problems, both from 103 and 110. Okay. So now coming to measurement period. See, acquisitions जो होते हैं ना, theoretically speaking, on one day itself, you are given fair value of net assets. On one day itself, PC is paid. On the same day, you get the net assets transferred. You get the equity shares transferred. All this happens academically. Everything happens on the same day in student life. Practically, ऐसा नहीं होता है. Practically, this never happens. Okay. We have seen we have been a part of recent acquisitions, and acquisition process जो रहता है, it is a long drawn process. Okay. कई बार तो क्या होता है, on the date of acquisition itself, you don't have all the data, but acquisition should happen. Otherwise, there is a chance that the deal may fall through. And after putting in months of efforts, nobody wants a deal to fail. Okay. So what these people do is they will end up making the payment right now. So for example, let us assume 31st March is the year end date, and acquisition takes place on 20th March. And acquisition takes place on 20th March, just 10 days before the financial year end. 31st March ka reporting hai. If it is a listed company, within the first month, I mean by 15th May or so, they will have to declare their results. Do you think in a 1.5 month period, I know the fair value as on 10th March of all the assets, all the liabilities, all the, what you can say, do I know exactly what is the contingent liability, contingent consideration, deferred consideration? Can I find all of this within a span of 1.5 months and also carry on my regular accounting, that is making the regular provisions, making stock, getting the stock statements, verifying of the fixed assets, depreciation, booking of my JVs? Can I get all this also done by 30th April? Can I get the consolidation impact also done by 30th April for the auditor to sign off? Answer is no. It is not possible. It is not at all possible. Okay. And Ind AS recognizes this difficulty. Even if you had to acquire it somewhere in September, it may be possible that you will not get the entire information by 31st of March. So Ind AS 103 recognizes this difficulty. It's a practical difficulty. And therefore, Ind AS 103 tells us that if in case you do not have the complete information, you can record a takeover entry on a provisional basis. That means the goodwill that will come वो फाइनल गुडविल नहीं होगा. That is going to be a notional goodwill. That is going to be a temporary goodwill that will be recognized on one of the reporting dates that it is going to come. This notional goodwill is not, I repeat, is not the final one. This notional goodwill is going to undergo a change. Well, why can it undergo a change? Why can goodwill undergo a change? Ind AS 103 gives only one exception. Only one exception. What is that exception? Well, that exception is that if you get any additional information, of the net assets of the subsidiary, okay, and that information pertains to a condition that is existing on the balance sheet date. That information pertains to a condition that is existing on the balance sheet date. If both these conditions are met, you have to get the information within 1 year from the date of acquisition, and it pertains to a condition existing on the balance sheet date. If both these conditions are met, then we will adjust the goodwill or capital reserve. If none of these conditions are met, or even just one of these conditions are met, we will not take it to goodwill. We will take it to profit and loss. Account. Is it understood? Yes. Have you understood measurement period? What is measurement period? 1 year from the date of acquisition. That 1 year from the date of acquisition, we will be recording the 1 year from the date of acquisition तक हमारे पास freedom है to record the change in asset or liability values and take the difference to your goodwill or capital reserve. But अगर मेरे पास time limit expire हो गया, I cannot have a perpetual open window to change the goodwill. By goodwill, be reasonable. Okay. 1 year is fairly reasonable after acquisition. You should get a complete idea of what is there, how the things are flowing, etc. over a 1 year period. And after a 1 year period, you will then proceed to make any adjustments thereafter in the profit and loss. Prior to that, in the goodwill or capital reserve. Okay. So this is my measurement period concept. ये जो goodwill बनता है ना, the goodwill that is arising in step number 6, याद रखो, this goodwill is a very, very, very special figure. This goodwill is a highly special figure. उसका हिफाजत करना पड़ेगा. You will have to protect that goodwill from any change in value. Ind AS give only 2 circumstances when this goodwill can change. The first one is what we have studied today, that is measurement period concept. The second change that we are having, we will be having on account of goodwill is impairment of goodwill, Apart from these 2 things, भूकंप आए, बाढ़ आए, आपका accountant का कुछ भी हो जाए, whatever happens in the company, the goodwill figure is not going to change. The goodwill figure is never going to change. Is it okay? Yes. All right. You will not depreciate the goodwill or amortize the goodwill. Okay. Amortization of goodwill is a concept of IGAAP. Do not bring that here. Amortization cannot happen of goodwill. Okay. All right. Special adjustment on measurement period. Okay. Where complete information of net assets of S, if complete information of net assets of S is not available, is not available with the acquirer, comma, Ind AS 103 permits provisional recording of goodwill on the date of acquisition. Okay. All right. Now, subsequently, if the following conditions are met, comma, corresponding adjustment will be made to goodwill or capital reserve. First one, additional information available within 1 year from the date of acquisition, and 2, additional information pertains to a condition existing on the date of acquisition. Conditions. Both conditions are met. Goodwill or capital reserve adjusted. One or none of the conditions met. P&L adjusted. Okay. So if this is the case, this is known as your measurement period adjustment. So you look at when you got the additional information, and after the additional information, you will also look at whether it pertains to a condition existing on the date of acquisition. Okay. You remember this was the case that we used to record adjusting events in your regular IGAP, as well as the current Ind AS 10, I think, Ind AS 10 or Ind AS 8. Okay, we used to do the recording of these adjustments of post-balance sheet date events. Post-balance sheet date events, we used to record it in accordance with whether they are additionally giving information and whether such conditions existed on the balance sheet date. Same concept applies here. Only thing is, it was extending up to the reporting process is complete. Here it is extending up to a period of 1 year from the date of acquisition. It is 1 year from the date of acquisition, as well as the additional information should pertain to a condition that is existing on the date of acquisition. If both these things are present, first one is within 1 year from DOA, pertains to a condition existing on the DOA. So these are the two conditions that need to be fulfilled. If these two are fulfilled, what are you going to do? you can adjust goodwill or capital reserve. If these two conditions are not fulfilled, then even if one is fulfilled, you cannot take the shelter of goodwill capital reserve. You will ultimately end up affecting or impacting your P&L. Have you understood? Yes. Have you understood? Okay. All clear, guys? All clear? Manini, all clear? Who all are watching? Is it all clear? Yes. Okay. So please try to solve whatever questions we have done. I am, for the time being, not touching on appendix to Ind AS 103. I'll see if I can, snatch in an extra session here and there if it is possible. If it is possible, I'll try to pull in an extra session and we'll try to do some stuff. Okay, let us see. So appendix to 103 is remaining, that deals with common control combination. We'll try to have a session on that. Okay, so thank you, Manini. Wish you all a very happy new year. Manini, Kaushiki, Aniket Jain, Soham, all of you, Srishti, Shailendra, Jagadish, okay, all of you, wishing Nidhi Deshpande, wishing all of you a very happy new year. Aniket Jain, Sumit Jain, yes, the last year of the last day of the year 2022. Tomorrow a new year commences. I wish that all of you attain success with the new year that comes up. Okay. One question, take for all topics. Shailendra, I'm not able to understand. Okay. Okay. Not able to understand. Please tell me what is your query. Manini had a question. Sir, how do you get the fair value of contingent liability? See, fair value of contingent liability, you can perform a probability based model, like how we have always seen it. Okay, probability based model in the sense that you can estimate that there is a 50% case that this contingent liability will materialize. There is a 50% it won't materialize, or there is, say, a 40% chance it will materialize, 60% chance it won't materialize. Then what do? You take an estimate of when the thing will actually materialize. 1 year, 2 years, 3 years, 4 years. So that point of time, this case will be decided. And if it will be decided, you discount it to the present value to determine the fair value of the contingent liability. This could be one way of solving. There could be multiple ways of determining the fair value. Okay, so it depends. I mean, our job is to record the transaction. Our job is not to do the fair valuation. But you can follow a binomial model, or you can follow a Black and Scholes model. Whatever model is there, depending on the inputs that you have, you can determine the fair value of the liability. Okay, so the fair value of liability we had also seen when we did Ind AS 113. Contingent chhod do, the fair valuation of a liability we've already seen in terms of Ind AS 113. A liability which could be an asset for the corresponding entity, or it may not yet be an asset for the corresponding entity. So if that is the case, how you would do the fair valuation, that is how you will calculate. Okay, so it depends. I mean, I gave you one example of weighted average and discounting to present value. Multiple ways are also there to calculate. Okay, so that's it. See you guys on Tuesday. We pick up consolidation on Tuesday. I have two major topics left in 103, that is common control and reverse acquisition. I have explained the concept of reverse acquisition, but I would like to do a question on that. I have the question ready. And the second one is, of course, common control combinations. Okay. So take care, everyone. Thank you, Rashmi. Thank you. Thank you, Nidhi. Thank you, everyone. And see you guys on Tuesday, that is 3rd of January, I guess, first, second, third, 3rd of January 23, with a new set. Okay, for consolidation, I'll be uploading certain formats. Okay, I'll be sharing it with the institute today, so it should be uploaded by Monday. So my advice is download those formats, take a print of those formats and keep it ready. They are nothing, they are just blank formats. It will save time on solving. It will save time on solving the questions. Okay, because there is a lot of clerical work in consolidation. We will be solving a lot of problems where formats start to get repeated. So my advice is take the formats and usi se hum log kar lenge. Okay, so with that we conclude. Take care. Bye bye. See you and Happy New Year. Okay. Sorry for extending your class. Okay. All right. Thank you. Ayaz.